Rivian Automotive Inc., trading under the symbol RIVN on the Nasdaq, officially concluded its last active trading session on Friday, June 12, 2026, at a closing price of $15.54 per share. This represents a substantial intraday surge of 7.56% on the day, outperforming the broader auto sector, which slid downward by more than 1%. Volume for the session spiked notably as the market reacted aggressively to major operational milestones, pushing the stock through an intraday trading range between a low of 14.48 and a high of 15.64. Because today is Saturday, June 13, 2026, the equity markets are officially closed for the weekend, meaning this price reflects the definitive market consensus heading into 2 days of intense institutional evaluation. While a typical investor looks at a 7% daily jump and assumes a standard relief rally, the reality is far more complex and indicates a structural shift in how large-scale capital is pricing the risk profile of this young automaker. While the headline news attributes this move to the formal commencement of customer deliveries for their highly anticipated R2 midsize sport utility vehicle, the underlying metric driving institutional accumulation is a massive reduction in the bill of materials cost structure that normal retail traders completely overlook. Wall Street did not buy the stock today because a few keys were handed over to customers. They bought it because the unit economics of the R2 platform suggest that every single vehicle leaving the Normal, Illinois facility is on track to be gross margin positive from day one, defying the historic curse that has plagued nearly every electric vehicle startup in modern history. The standard expectation surrounding Rivian for the past few quarters has been one of deep skepticism, with the mainstream consensus viewing it as a cash-burning boutique brand capable of building beautiful trucks but fundamentally incapable of achieving mass-scale financial viability. It is easy to see why that perspective took hold, given the massive operating losses reported in prior years and the immense capital requirements needed to survive in an industry dominated by legacy giants and entrenched electric first movers. Retail investors using basic investing sites or navigating their individual brokerage apps often looked at the cash depletion rates and feared a slow slide toward irrelevance. The prevailing story was that until the company could somehow construct its massive multi-billion-dollar manufacturing complex in Georgia, it would remain trapped in a high-cost, low-volume niche. However, challenging this common narrative reveals a different reality where management completely optimized its capital allocation strategy, electing to pause heavy capital expenditures in Georgia and instead maximize the existing capacity of its Illinois plant to launch the R2 line years ahead of schedule. By squeezing 20,000 units of near-term production out of an existing asset base, the automaker effectively cut its near-term financing risk by half, forcing short sellers to aggressively cover their positions as the threat of an imminent dilutive capital raise evaporated. When you examine recent stock movements through professional tools like the Interactive Brokers trading platform or look at active institutional portfolios inside Fidelity Investments, you notice that a profound reallocation has been taking place over the last few weeks. This 7% single-day move is not an isolated blip, it is the culmination of a broader trend where institutional money managers are differentiating between pure speculative plays and companies with verified structural backing. For months, short interest in the auto sector has been heavily concentrated in high-cost producers, but the moment the first public consumer deliveries of the R2 were announced, the risk-reward equation flipped. High trading volumes indicate that the initial sell-off following the first quarter earnings report, where the stock dropped despite beating expectations on the top and bottom lines, was an artificial bottom created by macro pressures rather than company fundamentals. Institutional accumulation often happens quietly behind the scenes before spilling over into explosive intraday moves, and anyone watching the order flow on an Interactive Brokers platform could see massive block trades being executed at the VWAP, or volume-weighted average price, throughout the morning session. This tells us that larger funds are no longer treating the asset as a speculative lottery ticket, but are actively building core structural positions, a trend that is mirrored across other highly liquid tech and automotive assets like Tesla stock, Apple stock, or Nvidia stock, as capital rotates away from pure software into tangible industrial tech execution. Understanding this movement requires analyzing the intense macroeconomic pressures that have dictated the entire automotive sector throughout early 2026. High interest rates have continuously suppressed consumer demand for premium vehicles, making the high pricing tier of the original truck and sport utility lineup a difficult sell for the average consumer. This macroeconomic headwind is exactly why the market reacted so violently to the shift downward in the auto parts and assembly sector during Friday's session, yet the company managed to break away from that gravity entirely. The expectation was that macro tightness would crush demand. The reality is that the lower entry price point of the new midsize line has unlocked an entirely new tier of consumer demand that was previously priced out. For an investor managing self-investing accounts through online investing platforms or seeking investment help from automated services like Schwab Intelligent Portfolios, identifying these divergence points where an individual equity completely detaches from its underlying sector momentum is the key to finding alpha. The company's ability to buck the broader sector trend proves that product-specific catalysts can completely override macro-level anxieties if the underlying value proposition is strong enough. Comment below how many shares of Rivian you currently hold, or if you are choosing to allocate your capital into alternative assets instead. To fully understand how this automaker arrived at this critical operational juncture, we have to look closely at its core business model and foundational assets, which separate it from the endless sea of speculative startups that went public via blank check companies over the last few years. Founded in 2009 by R.J. Scaringi, who continues to lead the firm as chief executive officer, the company spent over a decade in stealth development before ever delivering a single vehicle to a retail consumer. This lengthy development phase allowed the engineering teams to design an entirely proprietary hardware and software architecture from scratch, centered around a unique skateboard platform that packages the electric motors, battery packs, suspension, and thermal management systems into a single modular chassis. This engineering choice is what allows the company to rapidly develop multiple vehicle variants, ranging from the full-size R1T pickup truck and R1S 3-row sport utility vehicle to the smaller R2 and upcoming R3 platforms, without needing to reinvent the basic structural architecture of the vehicle every single time. Beyond the consumer market, a massive pillar of their business model is the commercial van sector, backed by an initial massive order from Amazon, which holds a substantial equity stake in the company. These electric delivery vans provide a highly predictable, high-margin revenue stream that operates completely independent of consumer discretionary spending cycles, offering a unique financial buffer that standard pure-play consumer automakers simply do not possess. The financial architecture supporting this operational foundation has undergone a massive transformation over the past year, highlighted by the massive joint venture agreement signed with Volkswagen Group late last year. This strategic partnership brought in a critical infusion of capital, beginning with an initial $1 billion investment that successfully closed, with a total planned commitment of up to $5 billion structured around specific technology sharing milestones. For retail investors looking at options on popular platforms like the Robinhood app or evaluating their options through SoFi Investing, this joint venture completely rewrote the bear case for the stock. Prior to this agreement, the common market expectation was that the company would run out of cash before the R2 platform could reach scale, forcing a catastrophic dilution of shares or a massive surge in high-interest debt. The reality of the partnership is that the company not only secured its medium-term liquidity needs, but also validated the inherent value of its proprietary electrical architecture and software stack, which the world's second-largest legacy automaker is now paying billions of dollars to license and co-develop. This structural backing completely changes how an investor evaluates the company compared to standard independent startups, elevating its status to a core technological provider for the broader automotive sector. Looking at historical financial results reveals how the company has systematically chipped away at its structural inefficiencies to reach this turning point. In the first quarter report for 2026, the company posted a net loss per share of 33 cents, which dramatically beat the consensus Wall Street estimate of a 63-cent loss, while revenues grew 11% year-over-year to reach $1.38 billion. Crucially, the software and services segment saw revenue surge by 49% year-over-year, bringing in $473 million, and demonstrating that the company is successfully monetizing its active fleet through digital feature updates, insurance services, and charging infrastructure access. This is where the business model begins to resemble a high-margin tech ecosystem rather than a low-margin traditional manufacturing operation, a distinction that is vital for long-term valuation models. Even though the stock experienced a knee-jerk sell-off immediately following that report due to conservative full-year delivery guidance, smart money recognized that the underlying operational metrics, such as the 9% gross profit margin achieved on specific components and a controlled capital expenditure plan of roughly $2 billion, showed an organization transitioning from unconstrained growth into disciplined, efficient scale. As we look toward the future, the central tension for this stock will continue to revolve around the execution of its optimized capacity plan and its ability to maintain positive unit economics as production volumes accelerate. Wall Street's expectation is that the company will face severe execution bottlenecks as it tries to scale the R2 line to its target of 20,000 units, while simultaneously navigating ongoing global supply chain vulnerabilities and federal safety investigations, such as the recent probe opened by the National Highway Traffic Safety Administration regarding potential suspension components in older R1 models. The reality, however, is that the company's engineering revisions have aggressively streamlined the manufacturing process, removing over 500 parts from the vehicle's structural assembly and reducing the physical footprint of the electrical wiring harness by miles per vehicle. These invisible design improvements mean that the capital required to build each subsequent vehicle drops exponentially, allowing the firm to target a base price under $50,000 for the R2 while maintaining healthy margin targets that can sustain independent profitability without relying endlessly on external capital markets. For investors utilizing modern trading ecosystems, whether executing complex option strategies via an interactive broker's account, managing long-term retirement accounts through Fidelity IRAs, or engaging in fractional share accumulation on the Robinhood platform, the path forward for this asset requires a strict focus on concrete operational catalysts over macro noise. The immediate opportunities lie in the potential acceleration of the autonomous robotaxi partnership with Uber, which aims to deploy up to 50,000 specialized autonomous vehicles over the coming years, potentially creating an entirely new high-margin commercial revenue stream that the market has currently priced at zero. Conversely, the risks remain anchored to execution consistency. Any delay in ramping the Illinois assembly lines or any unexpected drop in consumer demand driven by an unexpected macroeconomic contraction could quickly press cash reserves and force management to reevaluate their long-term infrastructure plans. Investors must continuously weigh these forward-looking risk factors against the verified cost reductions and structural corporate partnerships that have fundamentally decoupled the automaker from its past vulnerabilities. In summary, the dramatic 7% upward surge that carried the stock to its weekend closing price of $15.54 is a clear indication that the historic gap between market expectation and operational reality is finally beginning to close. For years, the market treated this company as an overly ambitious, cash-burning venture doomed to be crushed under the weight of its own capital requirements. The reality established by the formal launch of R2 deliveries, the multi-billion-dollar validation from the Volkswagen joint venture, and a disciplined pivot toward maximizing existing factory assets proves that the organization has matured into a lean, structurally sound competitor capable of achieving genuine unit-level profitability. As capital continues to analyze these shifting dynamics across major online investing networks, individual brokerage platforms, and institutional wealth management systems, the ability to look past short-term sector volatility and focus on structural unit economics will remain the defining trait of successful long-term positioning in the rapidly maturing clean